All right. Hi, everyone. Let's get started. Thank you very much for joining our webinar on early stage investment in the last mile distribution sector. My name is Emma. I'm head of the Global Distributors Collective. Very happy to have you all here today. Based on registrations, we have a pretty good mix of last mile distributors and people who work across the sector to support last mile distributors. So that's great to see. And thank you very much for all the questions that you fed in through the registration form. We're looking forward to more questions over the course of the webinar as well. So we can kick off by taking a look at the agenda for today. So we're just going to start with a little bit of context. So just tell you a little bit about what capital distributors are currently raising, where they're raising that capital from, and the main barriers that they face. And then we have 5 speakers joining us today from 5 different investors who all have a track record in supporting early stage last mile distributors. So we'll introduce them shortly. We will then have open Q&A and then we'll close out. So if you have any questions, please just send them through as we go via the chat box, and then the speakers will try and answer them as we go. Otherwise, we'll answer them in the open Q&A. Next slide, please. So first of all, what types of funding are distributors looking for? Well, as you saw when you registered for this webinar, we asked you to fill out a couple of questions, which included what kinds of funding you're looking for. So the data on this slide comes from that survey. We had about 70 respondents to this question. So the data is not totally perfect because I think we had some responses from people who are not last mile distributors, but this represents roughly 1/3 of our membership. And as you can see, a significant majority, about 40%, are looking for debt, 27% are looking for equity, and 24% are looking for both debt and equity, with 8% seeking all types of funding, debt, equity, and grant. In practice, a much larger percentage of distributors are looking for grants, but I think these results are reflective of the nature of this webinar, which is focusing much more on semi-commercial investment. And just as a basis for comparison, the last survey that we did on this topic, which was in May, June last year, which had a similar number of respondents, showed that distributors were primarily looking for grants. So nearly 50% were looking for grants. And then we had similar ratios for debt and equity. Next slide. So what we didn't ask about in the survey was the volume of funding that distributors are looking for. So if you are a distributor, it would be great if you could please answer the poll that I've just launched, indicating roughly what amount of volume you're currently seeking. And this will be useful for our speakers today as well in understanding who's in the room. So I'm just going to leave it open for another 10 seconds or so. About 30 people have responded. All right, so you should be able to see those results. Unsurprisingly, a significant majority are looking for a funding amount of somewhere in the middle. So between sort of 100K and up to 1 million, but mostly in that 250 to 500K area. All right, so I think that matches quite well with the speakers that we have on the call, but I will let them tell you whether that's the case or not. All right, next slide, please. So just to give you a sense of how this matches with our existing data, in our State of Sector report from 2019, we surveyed 72 last mile distributors, and on average, they were seeking 1.3 million. But this varied very significantly from 20K to 5 million. So unsurprising, given that this webinar is targeting earlier stage companies, that the volume of funding being sought is a bit lower. Next slide. So in terms of the challenges that distributors face in raising capital, well, again, from our State of Sector report a couple of years ago, 3/4 of distributors say that access to finance is their biggest barrier to growth. And the challenges that you can see here on this slide, I mean, they're really the same kind of challenges that you see all across the SME sector. So these are not challenges that are exclusive to last mile distribution. For early stage distributors, the main challenge with raising equity that we see is that it's essentially too costly and too time intensive to raise money, and small companies just don't have the resources. The main challenge with raising debt for early stage distributors is the substantial track record and turnover that is needed before companies are eligible for loans. And we just see that the ticket sizes for working capital loans that early stage companies need just aren't available. And a lot of local distributors also reference the fact that local banks are just not interested in the last mile distribution sector. And overall, we hear from early stage distributors that their biggest challenge is the high administrative burden and the heavy due diligence requirements involved in raising capital and the delays in disbursements, which make it really hard to manage cash flow. So I've got another poll here because I think we're keen to see to what extent these challenges reflect your experience. So listed here are the sort of top 5 challenges that we hear from early stage last mile distributors. So it would be great if, again, if you're a distributor, if you could flag which one of these is your biggest challenge with raising capital. And if it's not listed here, then please do say so and tell us in the chat. So we'll just leave this open for 30 seconds or so. All right. So it looks like the number 1 challenge is around the application processes and the due diligence requirements, followed by the need for smaller ticket sizes. Minimum investment amounts are too high. Someone has said that their biggest challenge is not reflected on this list. I'm not seeing anything come through in the chat yet, but hopefully we will soon. Here we go. Insufficient non-grant revenue needs to be over 1 million and wrong geography. Okay, thanks, Stuart. We do hear this a lot from members who are based outside of Africa and India and more broadly South Asia, that it's really challenging to raise capital because investors tend to have quite strong geographic focus areas. Thanks, Stuart. All right, next slide, please. So who's investing in distributors? Well, capital is coming from a range of sources. In terms of equity, by far the main source is individuals, family, friends, and business angels. For debt, crowd lending is one of the top funding sources. 1 in 5 distributors who've raised debt have done so from Kiva. So Kiva is a favorite in the sector. And crowdfunding was more important than ever in 2020, and it played a really big role in helping distributors access working capital quickly and helping them to weather the crisis. And these findings, I guess, aren't really surprising, given that most distributors are young and early stage, that they're relying on friends and family, that they're relying on crowd lending platforms. And also a lot of local distributors don't even look to raise equity. They're not interested in raising equity. They instead look to set up with grants, and then they look to grow with debt. But this picture does look quite different if we just look at the biggest and most established distributors in the sector. So we're currently finalizing a research piece looking at the growth and fundraising journeys of the 20 biggest last mile distributors in the space. And for them, the vast majority of their equity, over 70%, comes from international impact investors and specialized funds. And when it comes to debt, for these 20 companies, crowdfunding is still a major source of debt. But again, international impact investors make up nearly 50% of their debt raised. So it looks a little bit different for the bigger players. Next slide, please. So last slide from me, which is just to flag that there are a number of funders out there who do support distributors, but very few will explicitly focus on last mile distribution as a sector. I think D-Prize, who is an early stage grant funder, might be the only funder that has an explicit and exclusive focus on last mile distribution. We heard a lot over the course of 2020 that COVID-19 was making fundraising particularly challenging, and it's not quite clear to what extent this is still the case. So if you are actively looking for funding, I'd suggest checking out our funding database on our website, which lists those donors and investors who have the strongest track record in supporting the space, and also has examples of GDC investees that these funders have supported. So that is enough from me. So let's move on to our speakers. We are lucky to be joined by 5 investors who actively support early stage distributors. I'm excited to have them present their funding models to you. So we have Bethany Larson from Charm Impact, Eva Maria Stolz from Persistent, Ian Muir from VentureBuilder, Brian McConnell from SIMA Funds, and Paul Cook from elea Foundation. So just a reminder to please drop your questions into the chat, and speakers will try and answer them as we go, and we'll save the meatier questions for the Q&A. So I think let's start off with Bethany. So Bethany Larson is the Chief Investment Officer for Charm Impact, which is an impact investing platform that provides small-scale debt to clean energy startups in developing markets. Charm has made investments in Nigeria, in India, and Kenya, and is currently raising for another GDC member in Malawi. So Bethany, over to you, please.
Thank you. Thank you, Emma and Charlotte, for organizing this panel today. I'm really excited to be here. Actually, if you could just skip to the 3rd slide, actually. Yeah, that's perfect. Thank you. So hi, everyone. Charm is a crowdfunding platform that works at one of the earliest stages of the market. So hopefully I'll be able to address some of those challenges that you've noted in the polls earlier today. We provide loans anywhere from £10,000 to £250,000 for clean energy startups in sub-Saharan Africa, South Asia, and Southeast Asia. The amount that you are eligible for actually depends on the stage that you're at with your company, though the maximum that we'll approve for a first-time loan is $50K. Our prices range from about 12% to 16% per year. Our normal pricing structure is a 4% annual management fee and an 8% annual interest rate, but we have recently started offering currency protection because we realized that this was just such a major pain point for some of our borrowers. So in cases where we do share the foreign exchange risk, the interest rate increases to 12%. In terms of what we're looking for, stage-wise, we like to see that you've been around for at least 1 year as a company, just so you can show us a full year's worth of historical financial accounts and demonstrate some learning over the course of that year. We do not support research and development, so we expect that the company will have a product and at least a bit of a history of sales before we engage. Most companies we work with have managed at least 1 grant prior to applying and have demonstrated that they have a solid business model and at least a small pipeline of customers. Sector-wise, to date, we've been focused primarily on solar. We've supported solar home systems, small-scale commercial and industrial, 1 mini grid, and some productive use appliances. But that said, we are also open to applications from companies working in other clean energy sectors, such as cook stoves and biogas. And then we also wanted to emphasize that we have a strong bias towards local founding teams, as well as those that are either founded by women or empower women through their activities. Next slide. Great. So our application process is pretty straightforward. We have an application form. It normally takes companies about 2 to 4 weeks to complete the application and compile the requested documents. Then after that, it takes us maybe a week or 2 to review. We'll schedule an interview to ask any follow-up questions that we might have. And then if everything looks good, then we'll schedule a site visit to meet with the team, as well as see some of your previous installations and speak with a few of your customers. Obviously, this is kind of COVID dependent. So if it were not possible to schedule something in person, we could talk about alternative routes for making that final evaluation. And then, yeah, the last phase is just figuring out loan terms and making a final decision as an investment committee. I guess a few quick tips for success. So I guess the first two might seem obvious, but you'd be surprised. The top two mistakes that companies make when applying for a loan from Charm is that they either do not fill out the application form or they don't submit their historical financials. So this causes us significant delays because then we actually have to prioritize other applications that are complete. So, when you make an application, just make sure you're submitting everything and double check. Also, we don't expect everything to be perfect. I'm much more impressed by companies that are open about the challenges they're facing than those that try to make it seem like they have it all figured out. We don't have it all figured out, and we don't expect that you do either. So, it's better to be open and start the relationship from a place of transparency. So be open and honest with us and definitely demand the same in return. Then finally, I would just say err on the side of over communicating with investors. So you might have a really good reason for needing extra time, or maybe you're pulling together your audited accounts or waiting for a reference to come through, or maybe you've even decided that it's not a good time to take out a loan for your company. Just tell us. It's much better that we know the application will be delayed than to give us the space to wonder whether there might be communication issues in the future when it comes to things like repayments or reporting. And I guess the last thing I'll say is that even if you think you might be too early for a loan, feel free to get in touch anyways. I like to start building relationships with companies early because it's really helpful when we can get to know each other and also see your progress over time. So that's it for me. If you are interested in applying, we would love to speak with you. There's a link to the borrower questionnaire in the deck that they'll be sharing after the presentation, but I'll also drop it in the chat in a second. So anyone who's interested, feel free to fill it out and then I will follow up directly via email. So thank you.
Thanks very much, Bethany. Some great tips there. And we had this question a lot coming through in the registration form, actually, which was around how soon should I be approaching an investor? So thanks for answering that question as well. All right, so next up we have Eva. So Eva is a venture builder at Persistent, among other things, serving as an interim CFO for portfolio companies as part of Persistent's approach. Eva also recently supported the development of a financial modeling tool for the pay-go energy sector. And before joining Persistent, she helped build a microcredit organization in Uganda and worked as a strategy consultant at Bain & Company. So over to you, Eva.
Thanks a lot, Emma, for that. And very glad to see that so many of you dialed in today. You can skip to the next slide, please. Thank you. So why are we persistent? So I think the name is because we are actually very persistent in building climate positive businesses that drive both social and economic development in Africa. And I think what differentiates us is that we come in very early and we become a true partner to the companies that we work with. You can skip to the next slide, please. So basically what our model is, we call it a venture builder model. And it is a model, we invest both. We invest human capital and we invest financial capital. So basically what that means is that when we invest in a company, we often also second someone of our team to work alongside the entrepreneurs and help them with some of the gaps that they initially have. And this often takes the form of interim CFO positions, because that is something that we often see is a critical skill at the beginning that needs to be built up. And basically there we help with financial management, setting up the functions, helping with financial modeling, capital raising, but it is not limited to that. So depending on where the company is, we might also help them with the definition of their business model, take a look at their IT strategy, or support them with setting up the right legal structure. And then when it comes to the financial capital, so we typically get in very early, and we invest capital to take a company to the point where it can attract other third-party capital, basically at sufficient amounts. In terms of ticket size, our ticket size ranges between $50,000 and $250,000, and that is for one investment. But what we often do is we make follow-on investments after that. So our positions may reach also more than $1 million, but that is not at once, but over time, basically. And then I think when it comes to the approach, we try to be very flexible and fast in the way we originate and we make investments. So when it comes to the application process, for example, you can basically reach out via the contact form on our website. We'll have a first screen of the key materials, and then we have if it meets the eligibility criteria, if we are interested, we will have an introductory call, and then basically if the outcome of that is positive, we would already start with the due diligence. And sometimes we see that obviously companies don't have everything ready that it needs, but then we also work with the companies to put that together, basically. Next slide, please. Yeah, here you can see what our investment focus is. So we invest in companies that are based in sub-Saharan Africa, so that is our primary focus, but we also look at other global emerging markets more opportunistically though. In terms of sector, our main stronghold is in energy, so businesses that provide access to clean energy. And when it comes to that, we have done solar home system distributors, commercial and industrial solar, and more recently we have also looked into e-mobility solutions. Especially for solar home system distributors, at the moment we are interested in geographies where we are not yet present, which is, for example, Ethiopia and Madagascar, and we are very interested also in working with local entrepreneurs there who know the market very well. But it's not limited to that, and we are also looking into other essential products and service providers, such as, for example, water. Yeah, what I mentioned on the stage, we get in at a very early stage. So also to the question that was asked, really, even pre-revenue, if we have a great team with a great idea and we believe in the market potential, even if there is no revenue yet, we are still interested in having a conversation. And then as a principle, we want businesses that have both social and economic impact, and that use the commercial discipline to achieve that. So that really have the potential to be profitable at scale. Next slide, please. Yeah, this is an overview of our footprint. So as you can see here, we are basically present all over sub-Saharan Africa with solar home system distributors, commercial and industrial solar, but also some companies that operate a B2B model for impact ventures, such as IT service providers, for example. And then more recently, we made e-mobility investments in East Africa. And last one. Thanks for that. Yeah, and Persistent has really been part of the off-grid industry since its very beginning, and as such is a thought leader in the sector. So there are a couple of papers also on our website that you can look up with publications on insights and lessons learned. And also more recently, we have collaborated with Power Africa to develop a financial modeling tool for the pay-go sector. So yeah, this is really designed for companies to build a financial model. It has a user guide and you can download it on the Power Africa website. So this is hopefully also providing us, may be helpful to some of you. Thanks a lot. I'll stop it there.
Thanks, Eva. And if you can drop a link in the chat to that financial modeling tool, that would be great. I think we shared some info about it in one of our recent newsletters, but people on the call might have missed that. So that would be great.
Will do, happy to.
Thanks. And I should have flagged at the beginning that yes, 3 of our presenters today do have a focus on clean energy, but 2, so persistent being one and elea being another, look across sectors, so more broadly than energy access for those non-energy distributors on the call today. All right, so next up we've got Ian from VentureBuilder. Ian is a multilingual energy access specialist and the pipeline development lead for VentureBuilder. He's got 15 years of energy sector experience covering off-grid solar, mini-grids and clean cooking through roles with PFC Energy, Earthspark International, the World Bank and Catalyst Off-Grid Advisors. So Ian, over to you, please.
Thanks, Emma. So hi, everyone. As Emma mentioned, I'm the pipeline development lead for VentureBuilder, which is a relatively new facility focused on supporting African-owned and managed enterprises selling off-grid solar products, particularly in underserved markets. What's somewhat unique about VentureBuilder is that we don't just provide early stage equity financing, but we also support our operating companies, or OpCos for short, with enterprise development service packages. Now, with these packages, we help enterprises build strong foundations for success across their last mile distribution businesses. We concluded our first investments in August and October of last year and are currently in the process of scaling up our activities. By 2031, we expect to have 10 OpCos operating at scale across 10 different African countries and to help deliver 2.4 million connections directly benefiting some 12 million people. You can skip ahead 2 slides, please. So in terms of the value proposition, let's dig a little deeper into this. We can be broken into various elements. First and foremost, we look to work with African enterprises that have meaningful local ownership and management and whose local market knowledge differentiates them from the competition. And we value strong management teams that we can work with to ensure sustainable growth going forward. On our side, our team offers deep industry expertise and networks with a particular focus on pay-as-you-go and last mile distribution challenges. And our support is typically around 4 key pillars. So strategy and leadership, finance, operations, and consumer credit management. Next slide, please. It's important to emphasize that we're looking for longer term partnerships than many investors. So we actually expect to meet an early stage company's equity needs for 3 years and to provide EDS support for at least the first 2 of those. And investments are tranched and will grow alongside the business per its needs. We also work really hard to crowd in grant and debt financing for our OpCos and have already done that successfully. So after 3 years, much like Persistent, we support OpCos to approach institutional equity investors that will help their businesses with the next stage of growth. Next slide, please. So just a quick recap of what the opportunity looks like. VB looks to support African enterprises that know their customers, understand their local market, and importantly, are really passionate about electricity access. If you become a VB OpCo, you can expect to have your equity needs covered for 3 years, freeing up time for you to actually focus on building the business itself. And you can also expect direct support in helping building that business from our team of experts and access to a network of debt and grant providers. Next slide, please. So I know there's strong interest from the webinar participants in understanding eligibility criteria for the various funds. So I've got a slide just on that. I've already mentioned it, but one that's extremely important is that your enterprise is majority locally owned and managed. And the management team can be small, but it should be bringing local expertise that can give them an advantage relative to the competition. In terms of target market, we expect the enterprise to serve a core off-grid rural market with a limited reliance on urban or bad grid customers. And we prefer the customer base to be predominantly middle and lower income, residential and SME, as opposed to just serving the wealthiest clients. We don't have a requirement that enterprise already be selling on a pay-as-you-go basis, but we want them to have a roadmap to doing so. And we want the enterprise to be one that owns the customer relationship and the distribution channels. In terms of traction, we expect enterprises to be revenue generating, even if it's from other activities. And if their solar activities are limited, to have an existing customer footprint, which can be tapped. Next slide, please. Since I have a little bit of time left, I'll quickly say a word about some of our existing OpCos. So Energy Plus in Mali was our first investment in August of last year. They're Malian owned and managed off-grid solar business with the exclusive right to distribute D-Light products there. And now their parent company has a 25-year track record in the country and an existing distribution network, which is really interesting to us. And as part of closing, we were able to crowd in over $750,000 in debt and grants for them. And then our second opco, which Zua Energy, came on board in October. They distributed omni-voltaic solar systems and appliances on a pay-as-you-go basis to off-grid rural and peri-urban households in Malawi. I'll go ahead and wrap up here and just highlight that you're welcome to reach out to me at the email address in the slide if you're interested in partnering with us. Thanks for your time.
Thank you, Ian. Okay, so next up we have Brian from SIMA Funds. You can just go to the next slide, please. Yeah. So Brian is the Vice President for Africa at SIMA, and his big skill is underwriting business models serving low-income customers in sectors including microfinance, digital credit, consumer finance, and off-grid solar. He's conducted more than 40 underwritings in the last 9 years. He is a sub-Saharan Africa specialist and lived full-time in Africa for more than 10 years. And Brian doesn't have any slides, so he's relying on the power of his voice. So Charlotte, if you want to stop sharing, and over to you, please, Brian.
Thank you very much. Yeah, so I will just try and have 4 points first. One is just to give you a bit of context as to where the particular fund originated from. Second, I'll mention the sort of standard offering that we have for distributors. Third, just to mention a couple of points around underwriting from our perspective. And finally, the last point would be just what maybe makes our fund unique compared to others. So the history, so first of all, I'm speaking for the SIMA Angaza Distributor Financing Fund, which is a fund dedicated to small, locally owned distributors in sub-Saharan Africa. And the context is that SIMA has a larger fund, which probably is more commercially oriented for the wider off-grid sector. And we found a large gap in the sector once we got active around financing for smaller distributors and that they were being left out. And so we began to look into trying to fill that gap, and hence partnered with Angaza, which, as you know, provides a platform for monitoring pay-go in the solar sector. And that is where the fund really came from. So what the fund actually has on offer is debt, anywhere from probably $50,000 up to $500,000. Competitive interest rates, I think, amongst the small number of funders that are lending into this sector. Currency-wise, we're very flexible. So if you can manage currency risk, you can do so up to a certain threshold. Otherwise, we can try and finance it through back-to-back loans with local banks or via other hedging options like MFX. Security is also flexible, all the better if you can offer security, but it's not necessarily a prerequisite. And we understand that at this stage, you may have pledged everything to local banks. So we're also flexible and want to be supportive of, diversifying your lender base, and also not let security be prohibitive at the early stage. As far as the minimum requirements or underwriting, I think to mention just two of the main things, we think management, someone else mentioned local management, and we definitely found that that's a key factor. So strong local management, knowledge of the sector is important. We'd also look at, because the engine of many distributors is the quality of the receivables, we look closely at that. So you should have a clear methodology for managing those payments from customers. And finally, just a very pragmatic approach to liquidity management, and having a good treasury function, having investing in the finance part of your business would also be very important for us. What makes the fund a little bit different is we try to not do a conventional underwriting based on your standard financial ratios, audited accounts, management accounts, etc. We try and do something which is really data driven and uses data available to us via Angaza to be able to speed up the process for you and for us, and leverage the data that's available through that platform to underwrite more quickly. With that, I will leave it there. I really look forward to hearing. I'll try and get you my contact information. And anyone active, in this sector, we focus on the renewable energy. So mostly clean cooking and solar distributors in sub-Saharan Africa. Thanks a lot.
Thanks, Brian. Did you also want to just mention who your current investees are? Because I think you guys have made, what, 4 or 5 investments to date through the Distributor Financing Fund?
Yeah, just about. So they're all in sub-Saharan Africa. I can name, I think, 4 of them. Mwezi, Altec, DGE, Easy Solar. Those are some of the names you may have heard of.
Great.
Mm-hmm.
Okay, thanks, Brian. So last we have Paul. Paul is an associate at the elea Foundation. elea invests directly in social enterprises that strive for maximum social impact or in innovative entrepreneurial projects that are economically viable in the long term. The foundation not only invests financial capital, but also provides investees with business know-how, coaching, and access to its network. So Paul, I'll pass it over to you, please.
Thanks, Emma. Thanks also everybody for participating today. You can already go to the next slide, please. So yeah, Emma, you gave already a brief introduction on the organization. So elea is what we call an active philanthropic impact investor with the goal to fight absolute poverty. And the philanthropy comes from our founders who are donors investing through us into social entrepreneurs. And we are all based in Zurich, Switzerland. Our investment focus is on, as Emma quickly alluded to, scalable and innovative business models. So we search for proven startups and early growth companies. And so this usually means for us companies with a track record of 1 to 3 years that have proven their ability to generate revenues and also to have a kind of an outlook towards break even. And so kind of a revenue where we come usually in is around $500,000 US. Our ticket size is between 100 to 500,000 US dollars, usually more on the upper part of this numbers. Our vehicles are mostly equity, also sometimes loans or also equity-like instruments. And in terms of timing, it's all mostly between seed and Series A where we're coming in. Quickly talking a bit about more the process part of our investment. So in our due diligence, we mostly look at the business model, of course, the financials, making sure that everything is adding up. The team is something that is very important to us to build trust also as part of the due diligence process, and also the social impact where we are applying our own measurement methodology. And another important factor, of course, is also whether we can play a role as an investor supporting the company. And so once we come in, we try to be active and engaged as much as possible, providing in-kind support, also sending people on the ground if necessary, also kind of especially on the financial side of things. Concerning kind of the connecting with ventures, we're very happy to connect as early as possible, even if a company is not yet in our range. Also to get a bit an idea of how things are developing and also building a bit of personal connection. You can already move to the next slide. So last mile is one of our 4 topic areas. We have 3 others that are global agriculture value chains, employable skill building, and digital solutions. And so in the last mile sector, we are very much focused on supporting the development of market-based approaches that are distributing affordable and high quality goods to low income customers. And so very important to note, maybe that's a bit the difference to other investors, is that we are product agnostic. We are not so much focused on be it a solar product or more water, but what is important for us is really the innovation in the distribution approach. And so besides the pure last mile companies, we're also exploring opportunities in the informal retail sector, supporting companies and initiatives that are working on the livelihood and competitiveness of small retailers. And so giving you a brief overview of our portfolio, starting at the shop level, we have supported initiatives like Smart Duka in Kenya and Mi Caserita in Bolivia that are working on the development of small retailers. Then more looking at the distribution of products, we have invested into Smart in India, Dharma Life as well in India, and Copia. So companies really trying to set up efficient supply chains. And then finally, more on the enabler side, Angaza and Fundus Digital, companies that are working on digital solutions to facilitate last mile operations. Yeah, so if you're interested to reach out, you can contact me directly or reach out to our info address on our website. I think what is very important is that you include a pitch deck so we can already get a bit an overview of your company. And the whole process always starts with a quick conversation with members of our team to assess the potential fit between the two organizations. Yeah. I would stop here and happy to hear from a lot of you, hopefully.
Thank you very much, Paul. Fantastic. Well, that wraps it up from our 5 speakers. So now we're going to go into Q&A. So as I said earlier, there were a number of questions that came through in the webinar registration forms that we can turn to. But before we do that, I haven't seen anything come through on the chat that hasn't been answered yet. Just to answer, Richard, your last question around deadlines, none of these investors have a specific deadline or an application period. So no sort of urgency from that point of view. So before we turn to the questions that came through from the registration form, if anyone has a question now, please just feel free to unmute and jump in and ask your question, or raise your hand and I can call on you. If not, we'll move to the questions that came through from the registration form. Okay, so one question that's come in from Pim, which would be, how do you manage your due diligence in times of COVID-19? Which is a great question. And I guess more broadly, it's probably interesting to ask about how COVID has affected your funding model and practices more broadly. So who wants to take that question?
Yeah, I'm happy to. So yeah, this is a really interesting question, especially because when we initially started, we assumed that in order to approve loans, we would have to go physically, either Gav, my co-founder, or myself in person to meet with companies and see their previous installations. And obviously with the pandemic, that hasn't been possible. So what we've been able to do, it's been a bit different depending on the loan, but in one case, we were actually able to work through a local partner to set up an in-person visit with one of our partners that we had a previous relationship with. So they were able to meet with the company and take some photos and ask the questions that we needed. But we've also faced cases where that isn't even possible. And so in those instances, we've worked through recommendations. We've spoken to other funders who have done in-person due diligence and were able to share their views and experience with us. So that's how we've managed it so far.
Yeah, just to add to that on our approach there, I mean, very similar. I think for us, typically the last step of the due diligence would be a field visit. And so that is the part that at the moment we couldn't really do. And there, I think similarly, we try to well, first of all, spend a lot of time with the team just remotely, basically, and then also trying to to have local partners look into some of the aspects that we really want to, where we still have open questions, basically. So I think that is the aspect that changed the most.
Yeah, hi. I think the only thing I can add that would be not already said is that if you do use some kind of ERP or platform like Angaza, and you can share data or share access to that data, it can go a long way to validating, your business and your cash flows, and lessen, any kind of doubts that maybe are there without an on-site visit and an ability to actually meet in person and visit the premises of your business. So that's another tool that we have used. Thanks.
Yeah. On my side, there's not so much I can add. I think really the network and community side is very important, being able to validate some of the visits we would do otherwise on the ground through partners that are in the countries.
Thanks, everyone. And I can see that Roan's asked a follow-up question in the chat about to what extent that approach is viable for the long term, but I might let some of you guys respond directly to that question in the chat. I imagine that yes is the answer to that question. Another question coming in from Jan Cloyne, which is, to what degree do panelists consider local clean cooking enterprises as a sector that is increasingly appealing for investment, which builds on one of the questions that Katrine asked earlier in the chat as well. So I know some of you have explicitly mentioned clean cooking, but I guess it would be interesting to hear a bit more about to what extent that makes up, what percentage of your portfolio that currently comprises, and to what extent are you moving to do more in the clean cooking space? Who wants to take that one?
I'm happy to jump in again. So right now we don't have any clean cooking investments, but we're starting to see a lot more interest from pipeline companies. So we're actively looking at one now. And we're also noticing that there's several grant opportunities in the space for funders who are interested in dabbling in clean cooking. So we don't have experience in this yet, but are definitely planning on expanding into that area, in the next 6 months, hopefully.
Yeah, I mean, I think from SIMA's perspective, it's from the, what do you say, demand side. Clearly, it's an important service to provide to customers. So that's really seems quite clear. The clean cooking is a really big gap, in many of our target markets households. So from that perspective, that's clear that I think the demand is there, and providing a better alternative to some of the less efficient and polluting options for cooking. I think frankly, it's the viability of the business which is often brought as a key risk. And so we look for, obviously, for opportunities to work with companies that have a diversified portfolio, for perhaps they have products that are more viable, that can help support, a less commercially viable product, whether it be mobile phones plus solar plus clean cooking, or MFIs, microfinance institutions that have clean cooking products as more of a retention product. We look at all those different kinds of models because we see it as very valuable. And so I would be interested to hear also back as to the viability question, and particularly the cook stoves. Thanks. But that's our approach. We are interested, and those are some of the challenges that we face. Thank you.
Yeah,
from the VentureBuilder side. Sorry, go ahead, Eva.
Sorry. Yeah, no, I was just going to say, for persistent, I mean, it's not part of our current focus areas, but we are interested in it, and we are considering investments in this space. But I think similar to SIMA, I think the unit economics actually was one of the aspects where we have seen that often are not strong enough yet, basically. But yeah, I think it's definitely something that we are also going to consider in future, especially also because of the impact related to it.
I was just going to say that VentureBuilder, while it doesn't specifically look to support clean cooking enterprises, we have started working with a number of companies that are selling clean cook stoves and are interested in also selling off-grid solar products. And we see that there's significant co-benefits to those joint business models. So I'm expecting to see more of that going forward. And honestly, you see it with even some of the larger players on the continent of Africa that were maybe starting by selling off-grid solar products and now are also selling clean cook stoves. So there's clearly a strong opportunity there for doing both.
Thanks, everyone. We've had a couple of questions come in, which I think is really interesting around local ownership, because a number of you have mentioned that supporting local companies is a priority. So one of the questions is to just share a little bit more about how you define and measure local ownership and what that means. And then kind of the follow-on question is around whether the instruments that you guys provide you think are the right ones to support locally owned companies, or whether you think that they need to be tailored to meet the distinct needs of local companies.
I will take a whack at it.
Brave one, go Bethany.
So yeah, in terms of how we define local ownership, I mean, it's a national of the implementation country who is also based in country. I guess, in terms of prioritization, it's not like we would, just absolutely categorically not look at other founding teams. It's just when you're considering, all other things being equal, for us, we would prefer to invest in a local founding team, not, just because, it is such a massive gap. Gogla found that last year, 75% of all investment in this space went to just 3 companies, right? And they're massive foreign-owned institutions, right? So there definitely is a need to funnel more investment to local founders. But, for me, it's just also a smart business decision to invest in people who are closer to the problems they're trying to solve. And then what was the second part? Oh, if we think our funding model is the right one. Whew, big question. And I saw that coming from Leslie. So thank you for that. I think our model solves a lot of issues. We're able to provide small tickets. We're able to do it at a competitive interest rate. But I think there are still definitely challenges with solving this foreign exchange issue and currency fluctuations. And I think the models that are able to really provide loans in local currency are going to kind of outpace the ones that don't. Just my 2 cents.
Just to add, since we probably have the strictest criteria on that front, I mean, a lot of it comes back to kind of our raison d'etre. The idea for VentureBuilder came about because we saw how the vast majority of funds were flowing to these large foreign companies, and that a lot of these smaller African-owned and managed enterprises were getting stuck in this valley of death and really having a difficult time raising early-stage equity. And so the founding principle of VentureBuilder was to step in and support those enterprises. And we really think that these local entrepreneurs have a competitive advantage in certain ways, and that the capital is what was holding them back. And so that's the reason why we set ourselves up to operate the way we did. And we're finding that there's a very strong interest, to answer Leslie's second question, for the kind of solution that we're providing here, which is equity with technical assistance to kind of de-risk the investment.
Yeah, I think also to answer to that question, I mean, I think early stage equity is still largely lacking, and I think providing that in combination with assistance is also really targeted towards and hopefully getting more local founded companies in the sector. Yeah. And I think also when it comes to, I think one of the barriers actually there is often the lack of or the weaker ecosystem that they have access to of angel investors, for example, which foreign companies might have. So I think early stage equity that is flexible, that is not requiring a cumbersome due diligence process, is really also targeted to especially local entrepreneurs.
Thanks, everyone. So we've got a lot of questions come through. We don't have very long. I'm going to ask one question that I'd ask you guys to just thumbs up or thumbs down, which is, which of you are also focusing on distribution of efficient solar appliances, fans, refrigerators, TVs, and so on? So can you thumbs up if you are and thumbs down if you're not? Okay, so yes from Charm and from SIMA, and Eva, I can't see your thumb. Okay, all right. And a maybe from Ian. So Ian, you might want to respond in a little bit more detail in the chat. But I have a question around FX risk, which I think is interesting, and again came up in the webinar registration form, so I wanted to ask that one. Can any of you talk about how you manage foreign exchange risk and the costs that are associated with that?
Yeah, I mean, I guess from our side, we do it the conventional way so far, which is either through a swap with MFX mostly, or through working with a local bank to provide some kind of USD deposit against which a FX, a local currency loan, is issued. Those are the two main options, other than just managing the risk within certain thresholds. But it is expensive, of course, and it's the most expensive in markets that have the most volatility. So it can be a major factor, of course. So.
Thanks, Brian. Okay, we're going to have to wrap things up there. If you can just go to the final slide, Charlotte. Great. Okay, well, thank you very much, everyone. You'll see I've launched a feedback poll to hear your thoughts on today's webinar. Please do sign up to our newsletter if you're not already, to stay up to date with the GDC. We've got a lot coming in the pipeline, some webinars coming up in the next couple of months around gender inclusive strategies and around governance for last mile distribution in particular. So keep your eyes out for those. But otherwise, a huge thank you to our 5 speakers. That was really fantastic. And you answered so many of the questions that came through in the chat and in the registration form. Really appreciate you taking the time. We will share the recording and the slides and the contact details of the speakers in follow-up as well. So thank you very much, everyone, and enjoy the rest of your day.
Thank you. Bye-bye.
Thank you. Bye, everyone.
Thank you, Emma.
Bye bye.